What if you could buy a home with zero down, even if you were not a veteran and did not qualify for a USDA loan? That is the idea behind a program called the VA Alternative. Now, the name can create some confusion, so let's clear that up immediately. The VA Alternative is not a VA loan. It is not offered by the Department of Veterans Affairs. You do not need to be a veteran, an active duty service member, or a surviving spouse. There is no certificate of eligibility, and the program does not use VA entitlement. It is called the VA Alternative because it is designed to give qualified non-veteran homebuyers access to one of the biggest benefits normally associated with VA financing, the ability to purchase a primary residence with no down payment. Here is how the basic concept works. The buyer uses an FHA mortgage, along with an approved down payment assistance structure. FHA normally requires the borrower to make a minimum investment equal to 3.5% of the purchase price. The assistance is designed to cover that required down payment, creating a potential zero down transaction for a qualified borrower. For example, imagine someone buying a $350,000 home. A standard FHA loan would normally require a minimum down payment of $12,250. Under the VA alternative structure, qualifying assistance may be used to cover that $12,250 down payment. That allows the buyer to finance the purchase without having to save the entire down payment themselves. But zero down does not automatically mean zero cash to close. This is one of the most important distinctions buyers need to understand. In addition to the down payment, a home purchase normally includes closing costs, prepaid property taxes, homeowner's insurance, escrow deposits, appraisal fees, and other transaction expenses. Some of those costs may be covered through seller concessions, lender credits, or other approved sources. But the transaction must be structured correctly from the beginning. The program may also be combined with the HOPER add-on. HOPER is a separate homeownership research program. Qualified participants complete financial education before closing, receive financial mentorship after closing, and participate in ongoing research designed to study long-term homeowner success. Eligible participants may earn income equal to 3.5% of the purchase price, up to a maximum of $13,000. On a $300,000 purchase, 3.5% would equal $10,500. On a $400,000 purchase, 3.5% would equal $14,000. But the benefit would be limited to the program's current maximum of $13,000. Depending on lender and underwriting approval, those earnings may help with eligible closing costs, financial reserves, or reducing certain debts to improve the borrower's overall financial position. The exact use of the funds must be reviewed before the buyer enters into a contract. Buyers should never assume that every dollar can automatically be used for any purpose they choose. Some of those costs may be covered through seller concessions, lender credits, or other approved sources. But the transaction must be structured correctly from the beginning. This is not intended to be a solar lease or a separate solar loan that creates another monthly payment. However, the homeowner still needs to understand the installation process, warranties, insurance considerations, projected energy savings, and any responsibilities connected to the system. The Hopper earnings are also considered taxable income and may be reported on a 1099. That does not necessarily make the program a bad option. It simply means the buyer needs to understand that the money is earned income, not a government grant or a gift with no reporting requirements. Now let's talk about qualification. Because the underlying first mortgage is FHA financing, the borrower still has to qualify under FHA and lender guidelines. The lender will review credit history, income, employment, assets, monthly obligations, and the borrower's debt-to-income ratio. The property must be the borrower's primary residence, and it must meet FHA appraisal and property condition requirements. Zero down does not mean no qualification. It also does not mean someone should buy a home simply because the program makes the down payment available. The buyer still needs enough stable income to comfortably afford the mortgage payment, property taxes, homeowners insurance, utilities, maintenance, and the normal costs of owning a home. The loan also includes FHA mortgage insurance. FHA financing normally has an upfront mortgage insurance premium that may be financed into the loan, along with an annual mortgage insurance premium collected through the monthly payment. That means the VA alternative should not be compared only with the amount of cash required at closing. A buyer should compare the complete transaction. That includes the interest rate, mortgage insurance, assistance terms, potential second lien, monthly payment, closing costs, HOPER requirements, and long-term cost of the mortgage. The program may be a strong option for a buyer who has stable income and acceptable credit, but has not been able to save a traditional down payment. It may also help someone who earns too much for an income-restricted assistance program, does not live in a USDA-eligible area, or is not eligible for military financing. But every assistance program has rules. The buyer needs to know whether the assistance is repayable, forgivable, deferred, or connected to a second mortgage. They also need to understand what happens if they sell the home, refinance the loan, or pay off the first mortgage. Those questions should be answered before closing, not discovered afterward. The most important takeaway is this: the VA alternative is not for veterans. It is a zero-down strategy designed for qualified non-veteran homebuyers who want to purchase a primary residence without bringing a traditional down payment. When combined with the HOPER program, it may also provide additional help with approved closing expenses or financial reserves. It can be a powerful home buying strategy, but only when the buyer understands the mortgage insurance, assistance terms, HOPER requirements, solar component, and total monthly obligation. Zero down can help someone become a homeowner sooner. The real goal is making sure they are financially prepared to remain a successful homeowner long after the closing is complete. Just win the day.